Are royalties taxed as passive income in the United States? Have you ever wondered how royalties fit into the world of passive income? This question is quite common among creators and investors alike. Let's break it down in a straightforward way. In the United States, royalties are generally considered taxable income. However, whether they are classified as passive income depends on how involved the taxpayer is in generating that income. Royalties typically come from using intellectual property such as patents, copyrights, trademarks, or even natural resources. If you are not actively involved in the business that generates the royalties, that income is usually treated as passive income. In this case, you would report it on Schedule E of your tax return. This is a common scenario for many artists, writers, and musicians who create work that continues to earn money over time without requiring constant effort. On the other hand, if you are actively participating in the trade or business that produces the royalties, the income may be classified as non-passive. In this situation, you would report it on Schedule C. This means you might also have to pay self-employment tax in addition to regular income tax. Now, let's talk about the practical tax implications. If you are not materially involved in the business, you can report your royalties as passive income on Schedule E. However, if you are engaged in the business, you will report your royalties on Schedule C and pay self-employment tax. You can also deduct related business expenses to help reduce your taxable income. Keep in mind that royalty income is subject to federal income tax and possibly state taxes as well. For heirs receiving royalty payments after the original owner has passed away, the income retains the same tax character as it had for the deceased. This means it is generally treated as ordinary income. In summary, royalties can indeed be taxed as passive income in the United States when the taxpayer is not actively involved in the business generating them. However, if you are actively engaged, the tax treatment changes, and you may face additional taxes. Understanding these distinctions is essential for effective tax planning and maximizing the benefits of your royalty income.